There has been an upsurge in market turmoil, and repeated oil price drops have been blamed on China. Each failing link in their infrastructure has a domino effect on the rest of the country, forcing even those who aren't directly at risk to prepare for the worst. Even if China's food production is at an all-time high, if international trade is disrupted, everyone will feel the effects. Welcome to Financial Fortune, the channel where we uncover the hidden truths and untangle the complexities of the financial world. In today's eye-opening video, we turn our attention to a monumental event that has sent shockwaves through the global economy: China's industrial collapse. Join us as we bring you the insights and analysis that you may not be aware of yet. Get ready to discover the far-reaching implications and uncover the truth behind this significant development. This is Financial Fortune. It's not like the United States and China haven't been at war with each other for the past 5 years. The most recent front is the information technology industry. All of the above are only previews of the world's impending deglobalization. Despite government estimates placing the number at 1.4 billion, credible sources believe it may be as much as 20% lower. Despite the common belief that there is strength in numbers, China's population dilemma remains unresolved despite the country's efforts to conceal the truth. While there may have been short-term benefits to lying for 30 years, their deception has now come back to haunt them. The last straw that would break the camel's back and lead them to lose all goodwill with other countries would be if they admitted their population statistics or lied about them. Plus, they're already coming clean about the reality that their population is shrinking rather than expanding. Add to that the demographic disaster caused by the inevitable consequences of their one-child policy, and you have an elderly society that is losing members at a quicker rate than its young people can replace them. Coupled with the rising rate of unemployment and the ever-increasing expense of living, men and women are putting off having children until they can better afford them. In addition to battling two fronts at once, the Chinese government is also dealing with a disastrous property market crash. However, Lai Shu claims that as many as 30 billion Chinese property developers have defaulted on their obligations and gone bankrupt. The two largest property developers in history, Grand and Sunac, are both Chinese, yet 3 of the top 10 developers in the world have previously defaulted and gone bankrupt. The main problem is that China's economy is focused only on the building industry rather than the manufacturing sector. As the general consensus holds, $1 trillion bridge to nowhere will enhance GDP by a factor of 10, according to an old Chinese proverb. Now, without these builders and this sector, over 100 million jobs would vanish and China's economy will instantly reverse. A mortgage boycott began in China in 2022 and has since gained momentum, making it difficult for the government to stop. The CCP had been attempting to pull the housing market down to bear for months when suddenly they realized they had messed up. This has resulted in the Chinese money printing machines operating at full throttle with no brakes. However, avoiding the issue entirely isn't an option if we want to resolve it. They can only hope that the newly printed money will be enough to make up for the losses they've incurred. History, however, indicates that this is only a bandage to cover an open wound. It will take its course and end up becoming one of the worst crashes in recent history.
We've talked at length about just the structural nature of the slowdown that perhaps China is going through, right, as a bigger picture, not just, post-COVID or pre-COVID, and the limitations that policymakers have, even from the very top, to be able to turn that around.
As you say, there are structural limitations, but there are also policies the government can put in place to deal with some of these structural problems. Like, I think one of the big ones that people often don't think about, as you say, people talk about post-COVID or pre-COVID, or look at the immediate problems that the economy is facing, but the birth rate and the demographic changes that China is undergoing those are impossible to turn around. There's nothing any government has been able to do in the world to really turn around a slowing birth rate and a falling population like China is facing now. On the other hand, if you look at Japan, you can see a situation where the population has been falling for more than 10 years now. The workforce has been falling for even longer, and yet the number of people in work has actually increased. So if the government does actually put in structural policies to encourage more women to return to the workplace, encourage people to work longer, these kinds of things, that you can actually see a situation when you have a falling population and a rising workforce. But what we're seeing in China is that the government isn't able to do those things here. You're not seeing a big change in how many women are in the workforce. the government has been unable to increase raise the pension age, and so force people to stay in the workplace longer. So the government is facing a lot of these structural problems, like a secular slowdown in the economy, falling productivity, falling workforce, falling population, and yet it seems to be impossible for them to actually make the changes necessary to deal with those problems.
And we're seeing those struggles across a range of sectors in the Chinese economy, right? So what are some of the most pressing changes that need to take place?
Well, the biggest problem that the economy is facing is the housing market, and the biggest problem with the housing market is that it needs to collapse further. The demand for housing is not there, and the falling population means that demand for housing is not going to return to the levels that are available now. China still has massive overcapacity in house building. There are way more builders than there is actually demand for houses now, and that's not going to change in the future. The demand for houses isn't going to increase radically from the situation now. It may rise a little bit as people become more confident with that housing prices have stopped falling. It may rise a little bit more because there's still urbanization happening and people still want to upgrade the current housing stock, because a lot of the housing stock in China is very old. But you're not going to see a return to the levels of growth which was supporting the thousands of various developers across the country. So there still needs to be a shakeout in the housing market. And the problem is that shakeout is going to be damaging for the economy. It's damaging for demand. It's damaging for demand for iron ore, for commodities from other countries. It's also very damaging for the corporate sector. So the problem is demand is falling and needs to fall further because of the demographics, but at the same time they need to support the housing market now because the economy is in such a poor condition. So this contradiction is what they're facing, and so far they haven't been able to decide which is the better. Do they look long term and basically accept the housing market slowdown will continue and possibly get worse, or do they look short term and try and prop up the housing market and housing prices now to provide growth and jobs this year and next year?
There are a lot of contradictions, right? Another one would be where we're left with when it comes to the deleveraging campaign. There seems to be renewed commitment when it comes to looking at local government debt, which we know has continued to balloon during COVID-0.
Right, and this is another, I think the local government debt issue is one of those things that is an incredibly pressing problem, and there is a clear solution to it, which the central government doesn't want to do. The clear solution is the central government needs to step up and take more of that debt onto its own balance sheet. The central government's balance sheet is very, very good. The debt to GDP ratio of the central government is much, much better than many other developed nations, specifically Japan. If you look at Japan, where Japan is, China is in the situation that Japan was in say the 90s, where the central government has very little debt. There is more debt out in there in the community, in the corporate sector, and in local governments. And what has happened in Japan over the last 20 years or 30 years, say, is that a lot of that debt has been moved to the central government's balance sheet, and so allowed local governments and companies to repair their balance sheets. And so China has this solution, but what you're seeing this year and what you saw in previous years is the central government doesn't want to take on that debt, and they want to force it to be resolved out in the provinces. And so you're just seeing this debt problem, this local government financing vehicle problem, is ballooning in the provinces, and some of them are struggling to deal with it now. Guizhou is struggling to deal with it. Yunnan is calling out for help. In Mongolia, places in Mongolia are also asking for help from the central government. So there is a problem, and there is a solution. The problem is that that the central government doesn't want to take that solution, and so they're forcing it to continue on and to grow further.
And that concludes our revealing analysis of China's industrial collapse, a critical event that has far-reaching implications for the global economy. We hope this video has provided you with valuable insights and a deeper understanding of the ongoing shifts in the financial landscape. Remember to like, subscribe, and hit the notification bell to stay updated with our latest videos. At Financial Fortune, we're dedicated to keeping you informed and guiding you on your financial journey. Thank you for joining us today. Until next time, may your financial choices be guided by foresight and resilience. This is Financial Fortune, signing off.